learned to an election. Live in the hills, but I still get a spread. Started with a little, but I still reinvest it. Fear how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it down, we gon' get it.
All right, ladies and gentlemen, I got your Watchlist coming in at April 22nd, 2020, and today we're going to talk about the $900 into $20,000 oil trade. It is a trade I made today. We need to explain it. It's probably one of the craziest points, has a lot of stuff we need to talk about. Then we're going to talk about Netflix earnings. They just reported, but we did another play on there, and we were able to, looks like we're going to walk away as a winner. $3,600 is what we have on the line to win, but I want to go over both of these plays because really with what's going on in the market, there's a few different things. There's some political stuff. Even right now, Munchkin is pumping up the markets. We've got an approval for the PPP to get more money. We even got United Airlines issued more stock, and then we were even watching the earnings after hours. So if you guys, for any of these earnings, especially the big ones that are going to come up, make sure you tune in on the stream. We're going to be, even after hours, we're going to be watching the stream and, well, the earnings call. Okay, yeah, so be there. Don't forget. But there's a lot of stuff we need to go over. It's all contained into a few stuff, so I want to go over these plays, and these plays are crazy. And now, you know, you guys were getting a little crazy on me yesterday. A lot of, you know, so I got something for you, you know. So say you're going to get 1 million followers. They say I get 1 million followers if I just told you the plays. You know, instantly I was thinking, like, damn, like, how many would I get for feet picks? But I like it. Okay, so you know what? I'm going to give you let us get into the plays. I'm giving it to you right now. Let's see. Let's put this to the test. So right off the bat, I will explain that Netflix trade. We made $3,600 on that. We're going to hopefully make 20 grand off the oil. You don't care about that. So the first trade that I would go after tomorrow, the first number one thing I'm going after tomorrow, if I could get the same price I got, I'm going to get that trade on SCO. That is the oil trade. So again, you don't want to listen that far. I understand. But the next play I'm going to be looking at, XLNX. They have earnings after hours. So I'm sure, I don't know which one I'm going to do. I have a few things in mind when I say I want this play. And now naturally, like, well, I need the play. So if I was going to have to do anything, what would make the criteria? I would get the $60 straddle. I mean, this is part of our earnings criteria, but I would look at the 110 for around 50 or 60 bucks, and then I would strangle it, which means I would get a put and a call, and then I would go get, I think, this one. I mean, if you could get this one at 52 cents, but seems like you'd be getting the 55 or the 60 at 50 cents, $100 both ways. It plays the earnings, but it also gives you a few months. You may not make a lot. You know, again, if you do 1,000%, 50 bucks or $100 into 500. So keep that in mind. That's a more conservative play. If I was going to get really risky, I'd just take the same strangle earnings criteria strategy, 50, 60 bucks, go both ways. Look in here. And again, none of this recommendation. I'm sure you can't lose all the most financial adjustment. Please, financial adjustment. Personally, thank you. Have a wonderful day. So these are plays I was looking at, considering talking to myself. But if anything, I might even do the play that I would say, if I can't find a good deal, I'm going to be looking to do an XLNX, the strangle type play that we did on Netflix. So what we did with Netflix earnings, I'm going to do it on XLNX, where you just short the at-the-money contracts and then buy insurance on one of the opposite ends of the wings. So that is your second play. The next play, and then this stock had a crazy move, but LLY, Eli Lilly. And now you guys heard me talk about Eli Lilly. I brought this up even just for the credit spreads, but that's another play I'm going to be looking at tomorrow that I would say is a pretty solid opportunity. And what I mean by that one is a credit spread. I would be shorting the put credit spreads. And it's interesting because Eli Lilly dropped a lot. No, did they report today? No, they got downgraded. That's interesting. So they got down. That is very, very interesting. But I'll be looking to sell a put credit spread again, or even do the strangle play. Pretty much, Eli's a pretty solid stock. Again, I've talked about this. They've been there. So the idea would do a high probability. I think it was the 146, 147, or 145, 146. Market's pricing in about $7. It's like $5 out the money. Yeah, so 144, 145. That one has like a 50-cent credit, but $1 risk. So literally, it's like a 67% probability trade. One for one reward, risk 50 to make 50, or yeah, you could lose 50. That's the same thing. That is the second one. And then finally, to keep it short and simple, you don't like the explanation, Netflix continuation. So Netflix reported, we have that one play. We're going to go over it. However, oftentimes it depends on the market. What I mean by depending on the market, it depends. Do we get a market with a lot of movement, or does the market get, react to oil or any sort of news in the morning? and kind of just get pinned in a range, or it just kind of does a typical earnings move where it makes most of the move pre-market and doesn't do much. But if you see Netflix making a move up or down, a big move within the first 7 to 30 minutes of trading, I'm just going to get a play in the direction of whichever way it's trending after that time frame. Whether it's up, I'm going to get a call. If it's down, I'm going to get a put. But that's playing the continuation and seeing what we could set up there. And what I mean even further beyond that is the prices of the contracts will let us see is there opportunity to play even beyond just a flip on the short term or everything of that nature. So there you go. I want my 1 million followers. Those are your 3 plays. You can watch how those play out. Those are there, but those aren't the main plays. So we'll get into those. But wait, did I tell you guys, like the video, make sure you subscribe. We're live Monday through Friday, 30 minutes before open. Drop a thumbs up on the video. We better see you there in the morning. It's free 99. Costs you nothing to join. YouTube.com/the stock market. What are you waiting for? You can watch the plays. You can watch this live. And even when we made this crazy oil play, I posted and spotted the anomaly. I showed you it all live. Somebody clipped that when we first brought it up because this play is important. But as far as the market today, market closed down 631 points. I mean, it even gapped down. There's a lot of stuff. Mainly, though, it was oil. You did get some weird news yesterday with, like, Israel. Kim Jong is in the hospital. I think he's dead, but there's reports that something with his health is going on. I think he got clapped, bro. And then now they just passed more stimulus. I think there was one more thing, but it was a pretty crazy, overnight session. Oh yeah, Trump he talked about banning immigration, but it was a weird 24 hours. And then right off the morning, oil wasn't good at all. And that was the main point. Pretty much oil is still crazy. And what we even saw today was a flip flop between the May and the June contracts. So what I mean by that is if we come over here, let's go back to oil. This is now /CL. This is the one I talked about yesterday. That hit $6. So this is the main contract now dropping like this. This is wild. And then now if you even go to now CLK20, the May contract, this is now positive. It's at $9 and it's just trippy because now take a look, 906, 1303. But at one point, you had the May contracts worth more. And now what is this saying? What does this mean about everything? I did it again. I did it. I thought I did it. Oh my gosh. That's awful. I'm so sorry. So this is what I'm saying. Here's the CL. That's the main contract. And then CLK20. Again, at one point, you had the May contracts worth more than the June contracts. And again, this is just weird. And it is creating this flip-flop. And this is showing us that something is up. And now, I know a lot of you guys are new, or some people are new. And if you guys are new and you're like, does any of this make sense? It will make sense. It takes time. You got to immerse yourself. I mean, some stuff will be very, very foreign to you at first, but this is a lot of complex stuff. That's what the stock market is, but it is very simple once you just get exposed to it. So just keep getting exposed to it. So now something like that, I'm saying, the contract's going back and forth. I'm saying it's showing that something is up, but maybe I should rephrase it as what is up. It's already happened. It's already showed us that something was there. And what I'm saying is that there's an imbalance, and that's why you saw an extreme inverse. That's why, when one contract goes, the fact we even saw negative pricing with oil or any commodity for that matter, but now you saw a big move negative yesterday, and now that thing bounces up today, but then the contract next in line does the thing the other one didn't. The fact it's doing that is showing that there is already an imbalance. However, now this is going to lead us to even more stuff. And even the next point I'm talking about here with oil is that USO, the ETF, I explained this yesterday. Some people thought that part of this whole negative oil thing was related to what happened with USO. And now you even got a filing from them that they're going to be rebalancing it and doing the ETF a little different. So that could have been what affected it. But the fact that you're seeing the flip-flop in contracts, the first negative pricing, again, just the weird interaction between the short-term contracts and then now this June contract. But now that they're even changing USO, and this is happening now in a 48, 72-hour period, we even hit now $6 on oil. And that's just not good. Even the further and further you go on these contracts, that's what I'm saying, one by one, the longer you're going out, as these prices start to hit low and low levels, this is like very depressing pricing. That means, where the money is going and what the money is pricing in for the future. That's why if every one of these contracts just starts getting clapped one by one and they start deflating like this, that is what is up. That is what's happened. And the fact that you're only on future number 2 and this is just day 3 is showing that something has already occurred. but we could now reasonably assume there's more. But now it's also saying something needs to be fixed, and that could be that other thing that is up. But what is something? I don't know. I'm not that smart. And maybe we will never know. And that is the whole point. There is always with economics, and especially something in this deep nature. And again, just even where we're at the scale of receiving information, insiders versus retail public, you could see something's occurring, but there's going to be a reasonable margin of you're never going to know. And we won't be able to figure that out. So that's why when something's up, I'm not assuming you should connect the dots. I'm actually, saying maybe we should see what dots can connect or try to understand the move we saw. It has more to do than just now what the price did. The price did something, but the price is telling you something. And everything that we're seeing has all told us a lot. So that being said, check out oil. That is going to be the main key. That has been the main driver now of the news and what's been the most important. And somebody even said, with everything going on, if it wasn't for the virus, would oil drop the market? I would say yes. But there's often this is dislocation and this is divergence. But now specifically it's earnings, because now oil's dropping. But would investors will sell off maybe a little? They'll be hesitant, but there's already been a big sell-off. It's why, after seeing even some of these companies, it's oil's dropping. I mean, you could wait a couple days to just wait till earnings. I mean, I know they couldn't wait a couple days to do an emergency rate cut, but it's a little different here at that level. But you're seeing the market move in this earnings mode, and earnings mode is clearly the leader. Again, that's what I'm saying. Hence oil, the fact that we saw such a oil dropped 50% today, and the market, 600 points is bad, but not as bad as what we saw. So the market's a little bit harder to move, but and it's even showing us that stocks are kind of hard to move in it because it's in earnings mode, where stocks and a lot of indexes aren't going to move at the same pace. But now with stuff like Netflix and some of these earnings we're seeing, companies are moving. And really what I'm trying to get at and what I'm trying to explain here is that you've seen this if you've been watching and been on stream for a long time. There's been a lot of environments where trading in earnings has been a lot more difficult, where the stocks, there's so much underlying lurking news that it would prevent and kill any earnings run up. You could say that with Netflix. That's kind of expected, but we've seen good earnings move so far. We've seen some decent stuff. So you could still get some moves, but the question is now, will it hold? And then now, will this set up the winner, loser, loser, loser? That's what people are waiting for earnings. So that's why you could kind of ignore some of this stuff for a little bit, not too long, but earnings mode is kind of pricing in. Again, we're seeing that. We're already seeing some big companies about to get even more tomorrow. And then even next week, it'll get even crazier. So I will say though, with that, it is continuation season. That's what I'm getting at, and that is the final key, I would say, and that's where I think we're going to get plays. That's why that Netflix play I mentioned, I think that'll be good, and mixed in just what we've already seen with earnings, and now continuations both in the short term, but now let's hopefully earnings, it might break some of these premiums, and that is what I'm about to show you now, because once we get into this oil play, there is in the market now stuff that usually, and this play could be too good to be true, but pretty much earnings, think about it. Earnings even has a traditional IV runs up in earnings and then drops, but now think about what just happened with the event, and now think about earnings. It could create some pricing imbalances, and there could be some opportunities to, you could steal it. Don't tell anybody. But we'll talk about that. But you're going to see on this play, it's important. So, I won't waste any time. Let us get into the plays. So this is the main event. Again, option trading extremely risky. Everything. I will start off with the negatives. I don't know what's going to happen with this play. It seems too good to be true. The next part is SCO as UCO. If it reverse splits, that could affect the play and expose us to risk. You're selling premium. There's assignment risk. However, all of this gets negated by the simple fact that we own collateral with it. And we have not only that collateral, we have a lot of money up front. So let me just show you this play, and this will tell you why this play is just so crazy. Even throwing it up here on the Tastyworks, you can see it. Just look at this play right now. It's saying trade price negative $1,200, and that is what I paid for this trade. So what does that mean? It is literally saying that I've collected $1,200 to make this play. So this whole play combined, I didn't spend any money, but I received $1,200. So now, reasonably, if you collect money on a trade, that means we sold premium or there's some risk. You could even see here, this is another trade like that. All of these TLT plays, I've made $8,000 to buy and sell all of these plays because of how we structured it. That's the ghetto spread. But now what truly makes this play unique, this isn't TLT. All of these are options. This one was a ghetto spread. We bought the May 185s. We bought those for $400. They went up in value. We sold these at $15,000. That's how we're able to walk away with that play. But this is all options. This is where it gets groundbreaking, baby. This is a share. You own collateral. So you're telling me I got paid $1,200 on this whole entire transaction to walk away with shares in something. So this is where it gets a little bit crazy. So now we did 2 plays, and that's what we're going to talk about here. I'm calling it the oil glitch. I will do the math, and I'll break down what happened here and what you truly walk away with, and you'll see. But we're walking away with shares, and then I did another one, which was a ghetto spread. But we did a ghetto spread and then essentially did a covered call. So we'll start with how we discovered this issue, and this is what happened. Again, oil's telling you something, this big imbalance, everything that happened in oil, and now what it's leading option and market makers to price. They had no idea what was going on, especially on a levered oil short ETF like SCO. So it made the premiums go crazy, and I spotted that this morning, and I took advantage of it. Now, why did I spot it? Because I bought this play. Here is SCO. It's a $59 contract. It is for July. It has a decent amount of time on it. Now, how did I know about SCO? What happened? We bought this play. I mean, I'm sure if you go to the watch list on this date, we'll go through the history. Let's see. This will probably be a great example at swing trading, because we buy these with times, and we hold. My strategy, I hold till in the money or has value or expiration. I don't usually cut losses, but this was a bigger play. It was risky, but like I said, we've been talking about oil nonstop. So this was at the end of March. We bought this play. I bought it on March 26th. So I bought this contract at $14.50. And now I didn't make a move on it till today. As you see, that is my only history on this in the last 60 days on SCO. So I bought that contract for $1,400.50. So what happened? SCO started running up today. Oil had all of this fiasco. They came back to break even yesterday. So we were down on those plays. I was down $1,200 of the $1,400 a majority of the time. And then, because again, actually, let me show you SCO to give you a reality and to kind of just show you, what to expect with some of these plays. But I was this guy, we bought it on March 26th. It shot up, you're like, yeah, baby. Then it gaps up again. You're like, oh, shit, oil, baby. And then 3 days later, all your hopes and dreams are crushed. You didn't have any risk management. Then you panic sold because then you were up at $2,000 on this play early on. So then you thought it'd be a good idea to put $3,000 in a completely different play. And then now you're down on this play. And then now you're down on both of them. Then you didn't look at the cash balance, and now you got clapped. So it's something like that, but instead I did what I did. I held it on through here. Oil dropped. It finally slowly came up, and now it's back up. So as oil was shooting up today, and even then it's down after hours, you guys will see the beauty of this play. But now this play might not be available tomorrow. We'll go over the differences because of the premium, but now what happened here was I bought that play. We bought that now. It started to go up. And so I was on the option chain this morning as we were watching it. So then what did I do? Oh, man, we stole that, man. Look at that. Absolute steal. So again, this is what I'm saying. There was an anomaly with the contract. They were really, really expensive all across the board. And you'll notice something. It could be because the market is closed right now, but this was happening all day today. Most of these contracts have the exact same bid and ask. $1 doesn't mean shit. $5 means nothing to SCO because it does it so much. So what I did is that now I bought that contract for $14. So when the value was up this morning, I was like, well, I'll ghetto spread it. I shorted the $100 contract because I was like, this is crazy because it had the same bid at the $100 strike price as it did the same contract I owned. So literally the same bid on my 59 contract was the same bid on my 100. So I'm like, dude, if this is a liquid, it has $1,000 spread. I was like, I'm not going to get filled. I was going to sell at the bid anyways. So I was like, dude, I'm just going to ghetto spread it. So and again, it started to stick out to me. I was like, this is a very, very weird option chain. I went on, I showed this whole tasty. I did this on stream. I showed you guys this. I ghetto spreaded this. So now that was the first trade you see here. We bought this for $14.50, and then I shorted this trade I shorted it at $3,700. So I got $3,700. That's like what, a $2,300 profit net. So between both of these plays, I'm left with now $2,300 in cash. But also, I have both of these plays in the portfolio. This is the ghetto spread. So I own the right at 59. I sold the right at 100. So pretty much I can make anything up to 100. I get to keep the profit. Anything over, I lose, and I keep that difference. So I got $2,000 up front. That's a $41 difference, so I'd make another $4,100. I make like $6,300 off of this play. So if SCO goes crazy, oil goes nuts, and oil keeps shooting up, we make $6,000 and we have zero risk on the table. At least we walk away with this trade was $2,300. Now that's not the main trade. This is the glitch here. This is where it gets really good. So I said that play, and then our beautiful, lovely moderator, man, great people in the cult. Shout out our mods, shout out the cult. I love all of you guys. And this is why we need to source information. But he brought it up. He was like, well, I got that play for $10 a share. I was like, what do you mean? And then he talked about it, and then he was like, well, yeah, I did the covered call, and then the price, he's like, because he saw the premium and he saw how much I got on it, then he was like, well, I just sold that, but I did the shares instead, because we've talked about this play with SCO. We were like, well, you could buy the shares instead. Now is a good time to do it. So then this is the next play where it gets crazier. So he said it, and I was like, that's a good idea. I said it sounded too good to be true, and I said the only risk is if they split, but then I was like, well, if you receive a bunch of money up front, it doesn't really matter. Pretty much the contracts broke. There was uncertainty. The market makers will go crazy, and let me show you why. This is what we did now. So at 8:50 in the morning, I bought 100 shares at $52.98. We spent $5,200.98. But now I shorted the 100 call. So remember, I already shorted that one, but I shorted at 37. Oil kept shooting up. So oil kept shooting up. And then now those calls were at 4,300. So I was like, dude, this is a great deal. So I shorted it at 4,300. But now take a look. Pretty much now $4,300 is what I received. And I bought 100 shares. So instead of doing a ghetto spread, this isn't ghetto. This is a covered call. This is how you normally do it. You buy the shares and sell a call. So I bought 100 shares for $5,200, but I was able to sell the right to them at 100 at 43. So pretty much somebody paid me, aka the computer, because nobody in their right mind should do this. They put it on the bid. They gave me $4,300 to agree to sell them 100 shares at $100. So even then, even if I have to do that, they're going to pay me $100 for the shares I just bought for $52. I make a profit on that, but then I also get to keep the $4,300 they gave me right now. So by buying this, they pretty much agreed to buy the shares. They agreed to buy the shares I bought for $143 that I just bought for $52. So now, hopefully you see how this is crazy, because pretty much now you'll see the math. It pretty much makes it, you subtract these numbers. We'll throw up the calculator here. I mean, and here's the good part about it is that if you took, $52.98, $52.98, that's how much we spent on the shares, but then we got back $4,300. That's how much we paid to buy 100 shares. That pretty much brings your cost basis down to $9.98. So we essentially, by selling this covered call, our cost basis on 100 shares of SCO, we could hold forever, even if it splits or whatever, but our cost basis is now $9.98. So where does that get crazy is that pretty much SCO's never touched $9.98. So even if they'll probably do a split when they get close to here, but even before all this, it was at like $11. So it's almost impossible to lose on this trade, or you'll lose your $900. And again, I think this trade is too good to be true, and I'm admitting it. I think there's an unknown that I don't know about this, so please don't try this. I mean, this is, educational purposes only. So, but by the looks of it, it seems like this is a very, very solid play. Now, if it's so good, it's like, okay, well, here's the crazy part about all of this is you guys can't do this play. Oh, and then here's the calculation. That's why I didn't do it again on the calculator. But what I mean by that now is that this whole play has now changed. Because again, here's the crazy part. Let me just show you. Just look at the price of SCO. Even after hours, I mean, I don't know where it closed at. Closed at $54, but even after hours, it dropped. It's at $52 flat. So just really pay attention to what I'm about to show you here. And you'll see why this play was so good at the time, but why it's so different. And then we'll come back to the calculator. So this is what I want to take you back to. Here's the contract. You see, I've already made it. I made $3,800 on this today, but even between there, this is the whole point. On those shares, I'm down $135, but I'm up 2,000 on the premium. So, I mean, even if you viewed this trade individually, again, I sold this contract at $4,300. So notice the difference right now is that now the stock is $100 lower than where I bought it, but the premium is now down $2,000 already almost. So now you could see if you wanted to do this play now, and this is why I said, because we did this math, people are like, well, can you still do the play? Because as it was changing throughout the days, the premiums changed and started going down. It really did change everything. So here's the initial calculation now. Let's say you bought the stock right now at $52. You would spend $5,200, but then you would sell the shares, or you would sell that contract and get what? 2,890. That would be 2,310. But think about that. That means you're paying your cost basis is 2,310. 2,310, you would still, if it went back to those lows, you would still be actually losing on that trade. And then if it started to capitulate, you would really, really lose. Again, $23 is not $9. So do you see how it had that dramatic of a difference? Because again, that's what started to happen even through the day. It was also reversed because now if the premium went up, the stock was at like $64. So you would have bought the shares for $6,400, but then the premium, it stayed at $4,000. So again, it leaves you in a similar range around $24. So if the stock goes up too much and the premium doesn't go up, it's harder to execute that, or vice versa. The stock drops and then the premium isn't that high, or the premium goes down a lot, you could see, but you make the money through selling that covered call. But we took advantage of it at the right time. We noticed it in the moment. We saw the options going crazy, and it led to a pretty solid trade. So that is that oil glitch. If I could do that again at that same, anything under $11, I'd say, or $10 on SEO, it's good, because now there's a few ways. Again, we could win on it. Again, at the same time, if I have to sell in my shares, I would still make another $6,000 plus there. That's another, if SEO did go to 100 and I got assigned, I would still make another $10,000. So you'd see I make around $10,000 there on the shares, and then I would make another $6,000 or so on the ghetto spread. So it's like $16,000 for the total oil trade. But the best part is when we go back to it, we didn't spend any money. We got paid. There's zero risk. So that is the first play. The next play is Netflix. So now, and again, here's the breakdown of it with the ghetto spread. The difference was the collateral. We bought the contract, so that was the right for those shares at 59, and we sold the right to 100 at 37. We profit off the difference. The covered call, your collateral is the shares, and we sell a call agreeing to sell the stock at a higher price than what we paid, and then we got paid $4,300 to sell it at 100. We bought the shares at 52.98. So now the next play that we need to go over, we made this play, and it should lead to like a $3,600 profit. I'll show you the play. It was a Netflix strangle, and it was playing earnings, and I mean, pretty much here it is. You can see right here, it's a 4 option trade. We made this there at close, but what did I do is I did a strangle. It looks better to visualize when I show up the chain, but I shorted the 440 call, and then I shorted the 440 put. So you see I got 2,500 from that, 2,600 for the other. We shorted both of these contracts. They were at the money around 10 minutes, 15 minutes before close. So I collected the premium there, and pretty much on that play traditionally, if you short both of these contracts, I collected that $5,000 premium, and I'm pretty much saying this contract either way won't end. It'll end up less than $50 in the money. That's why I sold it at $50 premium, and I collect the $50 premium, $5,000. If the stock only moves $30 like I was initially expecting, you guys could watch the stream, then I would keep the $2,000 difference. So now in this case, what I did though, because the risk of that play would be if it goes more than $50 out the money, you sold these naked, so you're liable dollar for dollar, and that trade would require $8,000 buying power. So what I did instead is we shorted this play. We did the short strangle, but then we bought the wings. We bought insurance on it. So I bought the 490, pretty much that $50 out of the money. I bought insurance to make sure if it did go past that, then I'm pretty much capping my gain. So we bought that one, and then the same thing with the put. So that's the whole trade. I'm not going to fill it out for you. I'll show you the duplicate here. It makes it look a lot better. But you can see here, and I did that play, and I walked away with $36.33 credit. That is where we met Phil at. So pretty much now, what does this mean? Here's the look at it. I collected that credit, and it's saying if Netflix is higher than $404 and less than $475, I walk away with $3,500. But now if Netflix is higher than 404, or excuse me, if it ends up being less than 404 or greater than 475, I would lose the money. So it's a defined risk trade, even though they're selling premium. You need $1,400 collateral to make the trade instead of $8,000 with the strangle. It's protected, it's insured, but I like it. Pretty much, if Netflix stays in a range, I make $3,500. I'm pretty much saying now that I thought Netflix was going to move, and that's what I said. I said it. I was only expecting about a $30 move, and now the main reasoning behind that was how Netflix moved. And now this is the key. The premiums were really high. The market was pricing in a lot, and it was also understanding, it was understanding that a lot could happen with this earnings and what's going on. But now when you go and look at the stock, you have to think about what happened. And this is the main point I want you to really walk away from, is how Netflix moved coming in earnings. It literally moved up $60 in earnings, and it was pricing in $60 in earnings. So pretty much it had a majority of the move there. So even though it already moved a lot, the market was still pricing a lot. It was like, well, a lot could still happen. We never know. That's why the premiums were high. So the premiums were high. That's why I wanted to sell the premium. Stock was pricing in 60. I pretty much gave more weight to the move that happened prior. So regardless of whatever the stock was pricing in at the time, I gave more weight to how it moved into earnings, because that, again, it's the underlying value of the stock, and the underlying asset is what you're trading. So there was that play. It's a little complex, but you could see with earnings now, this is how I'm playing these strategies. And hopefully you guys understand here, because now, let's say you miss a play. Like I missed out on Walmart. I missed out Netflix at the beginning. Isn't that, think about that. The funniest part, called out the Netflix. I wanted to flip Netflix coming into it, but what happened? I was too slow. I didn't get that run up into earnings. If you held into earnings, now some people you might still have value, some people might get clapped, but now I'm still, by the end of Friday, as long as Netflix ends up higher than 400 and then less than 475, we're going to walk away with 3,600. I might even get like $1,000 on it tomorrow. We'll see, but hopefully you see there, still walking away with money. The premiums get too high. You could sell them coming into earnings. If the premiums are cheap, you could play them, and then if they're cheap enough, you flip them. You play the strangles. If they're too expensive, you sell the straddles. It's very, 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 very simple, man, Or you get the idea. But that is pretty much it. I think I'm going to leave it there. There is a few other companies we're going to look for. Some of the same ones. Watch out for earnings and the main companies you have tomorrow. Like I said, XLNX is pretty much the only one I'm going to be interested in. I think there's a few others, but it's going to be like the airlines and stuff like that. I'm not going to play them again. Walmart, all those different companies with earnings. The biotechs, I'm still holding everything else. TLT was great, but we'll go over all of that. Snapchat, I do want to focus on the sympathies. Snapchat's earnings call was interesting. There's this expectation that all earnings for advertisers, everyone's kind of expecting slower ad spend. So I think I'm going to focus on those sympathies, but playing earnings, responding to these, the continuations, and what we could finesse from here and responding to the news. But overall, I love the positions that we're in. I'm getting free plays, getting it covering oil, the trifecta minus gold. We already took profits on gold at a good time. Things are looking pretty decent here now, especially with how things are shaping up. So that is your watch list, ladies and gentlemen. Make sure you're hydrated, healthy, ready to go. Make sure you post your watch list. Make sure we see you there in the morning. I need your helmet on. I need the armor shining. This is the game time. Remember, whatever the door looks like doesn't tell you what's behind it. It could be a small door leading to an auditorium or a big door leading to a box, baby. Don't get fooled by opportunity. That's a very, very insightful analogy coming into earnings. That's how the run-ups look. That's how the earnings look. Get ready and focus, and do not add more than you've allocated monthly. You got to balance the budget. That's it. It's very binary. You stick to the strategy and swing it. If you pick how much money you got, you go for the earnings plays. Oh, I lost the money. Oh, well, try again. That's it. I don't want any excuses. Let's go, baby. But I need you focused. I need those helmets on. The code loves you. I love you. I'm going to see you in the morning. Let's go.